Let's be real, trying to buy a home in British Columbia is already a huge challenge. But when you've got a rocky credit history, man, it can feel absolutely impossible. But what if I told you it's not? Today, we're going to pull back the curtain and show you the real-world paths to owning your own home, even if your credit score isn't perfect. So here's our game plan. First, we're going to tackle that big barrier head-on. Then, we'll break down what those credit score numbers actually mean. After that, we'll open up the Borrower's Toolkit and look at all your lending options, right here in BC. And finally, we'll lay out a clear path for improving your financial future, one step at a time. All right, let's dive into Section 1, the bad credit barrier. This is really the first hurdle we've got to clear together. Maybe it was a past bankruptcy, a few missed payments when things got tough, or heck, maybe you just haven't had a chance to build up much of a credit history. Whatever the reason, it all boils down to this one massive question. Is the dream of owning a home in BC still on the table for you? The answer is a clear, simple yes. It absolutely is. The path might look a little different, maybe a few more turns in the road, but homeownership is definitely not off the table. So let's start figuring out exactly how we get you there. So where do we start? Well, you can't win the game if you don't know the rules. We're about to decode the whole credit score system, so you can see exactly what lenders are looking at when they see your application. Okay, so think of your credit score like your financial reputation, all boiled down into one single number. For a lender, it's pretty simple. A higher number means you look like a safer bet, and that makes them way more willing to hand over a loan with a good interest rate. So here's where it gets really interesting. You'll see that poor officially starts below 560. But for the big banks, the real line in the sand is usually around 680. If your score is below that, you're probably going to get turned down. And that's exactly the zone where we need to start looking at different options. Now, get a load of this number, 150. That's how many points your score could potentially drop from just one single late payment. It's crazy, right? It just shows you how fragile a good score can be and how one tough month can really set you back. And that's why you have to know what's causing the low score in the first place. Is it a couple of late payments? Or maybe it's high credit utilization? That's just a fancy way of saying you're using more than 30% of your available credit, which makes lenders nervous. It could also be a past bankruptcy, an old phone bill that went to collections, or even applying for a bunch of credit cards in a short period of time. Figuring out the why is always step one. Okay, so we know the why. Now let's get into the how. This is the exciting part. We're going to open up the toolkit and look at the different kinds of lenders who are ready to help when the big banks say no. So on one side, you have your traditional banks, the A lenders. They've got strict federal rules and, as we saw, they want to see a credit score of 680 or more. But then you've got the B lenders. These guys are a super important middle ground. They'll often work with scores as low as 500 or 550. The trade-off? You'll need a bigger down payment, usually at least 20%. But here's the key. Think of a B lender mortgage as a stepping stone. It's a temporary bridge that gets you into your home while you work on rebuilding your credit. But what if your score is even lower than that? Well, that's where private lenders come in. And their whole perspective is different. A private lender cares way less about your credit history and way more about the property itself, specifically how much equity you have. Now, the costs are higher, for sure. We're talking interest rates from 7 to 12% or even more on very short terms. This is a highly specialized tool, best for things like short-term bridge financing. And there are a couple of other paths to think about, too. Here in BC, our credit unions can sometimes be more flexible because they operate under provincial rules, which means in some cases they might not even require the federal stress test. And then there's the CMHC insured route. If you can get your score up to at least 600, this could be an option. But you'll have to meet some very strict rules about how much debt you have compared to your income. So let's say you've used one of these tools. You got the loan, you got the keys. That is a massive win. But the journey isn't over. This next part is all about the long game. It's about building a strategy to improve your finances so you can move on from that temporary solution and into a permanent one with the best rates possible. Looking for some quick wins? These are the most powerful things you can start doing right now. First, and this is the big one, pay every single bill on time, no exceptions. Second, keep your credit card balances low. That magic number is under 30% of your total limit. Third, hold off on applying for any new credit, like a car loan, right before your mortgage application. And finally, go get your free reports from Equifax and TransUnion and check them for errors. You would be shocked how often mistakes pop up. Want to get a little more advanced? Here's a 30-day power play. Step 1.
Make a payment on your credit cards before the statement date. That way, a lower balance gets reported to the credit bureaus. Step 2. Call the company for a card you've had for a while and ask for a credit limit increase. This instantly drops your utilization ratio. Step 3. Set up automatic minimum payments for everything. That way you can never accidentally be late. And 4. The second you find an error on your report, dispute it.
Now, the key here is being patient and consistent. This isn't an overnight fix, but if you stick with it, you'll start seeing the results of those good habits in about 3 months. By the 6-month mark, you should see a real, noticeable jump in your score. And after a year of this focused effort, you could be in a fantastic position to refinance with a traditional A lender and lock in those awesome low rates. And if you take just one thing away from our entire conversation today, please let it be this. A bad credit mortgage is not the final destination. It's a vehicle to get you where you want to go. The absolute key to success is to always have a clear exit strategy, a real plan to fix your credit so you can graduate to a better, cheaper mortgage down the line. So, after all this, the power is really back in your hands. You've seen the hurdles, you get how the system works, and you know what tools are available to you. The only real question left is, what's your first step going to be?